So hello student, once again we have Macroeconomics chapter 2 part 1, and the chapter name is National Income and Related Aggregates. So let's go. So today we have a topic to cover: net factor income from abroad, factor income and transfer income, depreciation and meaning of net and gross, meaning of factor cost and market price. I would like to say one thing here, that is meaning of net and gross and meaning of factor cost and market price. It is not any particular topic given in the book, but if we clear about the concept, if we have a concept, better concept of net and gross and factor cost and market price, then definitely it is easy to understand the related aggregates. So first topic we have net factor income from abroad. So if we say that this is the difference between the aggregate flow of factor payment from, that is plus, and to, that is minus, to the rest of the world, uh, or another word we can say that NFIA is the difference between the factor income received from abroad and factor income paid to abroad. So easily we can understand this by a short example. Just suppose some Indians are working in USA and some USA's people working in India, but at the time of when we have to calculate the national income, so we have the difference between the USA's income and Indian's income. Just suppose this is the India and this is the USA. So very easy, some USA's people working in India and some Indian people working in USA. When Indian income is more than the USA's income, then definitely this net factor income is known as from abroad. And same case, when USA's income is more than Indian income, whatever in India and outside India, so this NFIA is known as to abroad. uh, you can say the net factor income from abroad is now known as the net factor income to abroad. So be careful, when there is from, you have to take use a plus sign. When there is to, then you have to use negative sign. So now component of NFIA. There are three components of NFIA which is generally added in the national income: net compensation of employee from abroad, that is compensation received by the resident working abroad, minus compensation paid to non-resident working in the domestic territory. Net income from property and entrepreneurship. It is also the difference between the income received by the resident in the form of rent, interest, profit and from rest of the world, and minus income paid to the non-resident in the form of rent, interest and profit to the rest of the world. Net retained earning of resident companies abroad, retain earning abroad minus retained earning of foreign companies located in a country. Now next, that is factor income. We simply talk about the definition for the factor income. Factor income is basically known as factor of production, and there are four factor of production, that is land, labor, capital and entrepreneurship. Land gives us rent, labor gives us wages and capital gives us interest. And if we talk about entrepreneurship, then entrepreneurship gives us profit. So these are the four factor of production which is generally known as earned income, and this income is added in the national income. Next, transfer payment. Transfer payment or transfer income is payment from government to individual as a form of scholarship, as a form of pension or as a form of any allowance. It is not included in the earned income, so this is not included in the national income also. So this is the transfer payment. So here we have a factor difference between the factor income and transfer income. Factor income, it refers to the income received by the factor of production for rendering factor services. Factor income of normal resident of a country is included in the national income. Example, rent, wages, interest and profit. And if we talk about transfer income refers to income received without rendering any productive service in return. It in one side unilateral concept. It does not include it in the national income just because of it is not a earned income. Example are old age pension, scholarship, unemployment allowance, and all types of allowance which is provided by the government to the individuals. So next topic we have depreciation. Depreciation is also known as the consumption on the fixed capital. Depreciation is defined as loss or fall in the value of fixed assets due to the normal wear and tear and expected obsolescence. The difference between gross and net value is also known as depreciation. We have a calculative formula to calculate the depreciation. Gross minus net equal to depreciation. Causes of depreciation. First is normal wear and tear. Normal wear and tear we can say when any particular machine or assets used for a particular period of time. So every year there is decrease in the assets value, and that is in the form of depreciation. And next one is expected obsolescence. Expected obsolescence, you can understand here that when any new technology introduced, then old technology replaced. So whatever amount we have to face, whatever amount we have to maintain here, this is depreciation. So next, gross and net. Gross, to describe the total amount of something, and net, to describe the amount that left after all the necessary deduction have been made. So there is some example of gross and net. Gross profit, gross weight, gross lease, net profit, net weight, net lease. So already you understand here that difference between gross and net, now known as depreciation. That depreciation is the particular amount we have to deduct from the gross to calculate the net. So this is the gross and net. And related aggregates of the national income, every aggregates have the term suffix of gross and net. So that is market price and factor cost. Most important thing, just because of if market price and difference between the market price and factor cost is clear, then we can easily understand the related aggregates of national income. So first is market price, refers to the money value of all goods and services produced in an economy in a year at current market price. Market price included indirect tax. If we talk about factor cost, refers to aggregate of factor costs, rent, wages, interest, profit for producing goods and services. It can be calculated by deducting indirect tax for or adding subsidy to market price. We have a calculative formula for the market price and factor cost. Market price equal to factor cost plus indirect tax minus subsidies, or we can say in the form of factor cost. The formula is factor cost is equal to market price minus indirect tax plus subsidies. Should be clear here that indirect tax added to the factor cost, then we make the market price, and when indirect tax deducted from market price, when we make the factor cost. So this is the one example of the related aggregate, that is GDP at market price and factor price or factor cost.
GDP at market price equal to GDP at factor cost plus indirect tax minus subsidies. GDP at factor cost equal to GDP at market price minus indirect tax plus subsidies. So should be clear here that there is a difference here that market when market price and factor cost, and the difference between the market price and factor cost is only the indirect tax. When from when we deduct indirect tax from market price, that converted into the factor cost, and when we added indirect tax to the factor cost is converted into the market price. So this is all about today. In next lecture we will start the related aggregates of the national income. Till then, thank you.